Host, can you give me permission to record and then we can get rolling?
Yeah, for sure. Yep. Well, you want me to record or are you recording? I just hit record on my side.
You're good then. We're good to go. So Mark, Tom, welcome guys. You're our guest for tonight. Many of you probably will already know Mark Ainley and Tom Shallcross, hosts of the new podcast, which, rats, the name just escaped me. You're looking at
it is.
Yeah. Straight up Chicago Investors Podcast. There we go. So welcome, guys. I'm going to kind of let Mark drive the ship here as we get started. We're going to have a panel discussion for tonight.
Well, cool. Well, thank you for having me. And those that don't know me, my name is Mark Ainley from GC Realty. I got Tom Shallcross, buy and hold flipper investor. And you guys all know John. And what I wanted to, when I was talking with John last week, I said, man, this is what we should do. We should get you, me, and Tom as call it a panel, and we should really just kind of drill each other on questions, because the amount of information that we are privy to on a daily basis is, we take that for granted. I think some of the things we'll ask tonight are things that we already know as natural that I think so many people could benefit. So, it's been a crazy year. 2020 has been, personally, business-wise, almost to the point where when something happens or something good happens or something bad happens, you're like, geez, of course, I should have seen it coming. It's 2020. So that's almost the mentality people are starting to have. It's like, anything can blindside me at any moment now. But yet, we're all on here tonight because we're all some level of opportunists and entrepreneurs. So no matter what's happened to us thus far in this 2020 year, good or bad or indifferent, we're still here looking for opportunity. We're looking to grow our net worth. We're looking to, set out on the idea of investing in real estate and making a lot of money from it. So I think that's awesome that you're on this call and you're able to keep up this, your momentum through all these crazy times when it's easy for people just to kind of hang it up. But so we'll kind of go back and forth tonight. I was going to, kind of start off here. And we can make this interactive in the sense of you can unmute, you can say something, but yet at the same time, we have chat there. And I will kind of keep an eye on the chat. And if you guys want to send a question while we're doing it, that's the easy way. So if you're a little shy or something like that, I can just simply say that Vicky asked has this question for you, John. What do you think about this? So we can keep it we can keep it flowing that way. And we encourage you to ask questions as we go. So is everyone cool with that? Kind of give me a thumbs up. Everyone cool? Tom, give me a thumbs up. You cool with that as my co-host here tonight with John? All right, cool. All right, good deal. So, kicking it off, John, you are, I think you bring two huge values to this conversation, being an investor that manages pretty much a majority of your portfolio. And you also are a broker who has, what being a broker right now means is you have a pulse of what's going on, especially in the investment realm that you're working in. I think that's so huge. Some of the insights that you don't realize you're getting on a daily basis, you take for granted. So talk to us first about, and you could keep it to your area that if you want to talk citywide, but what does inventory look like right now? And when you're when someone calls you up today and says, hey, I want to buy an investment property in the next few months, what kind of tips or what kind of conversation you're having with them around inventory and opportunity as far as available properties?
Yeah, that's a really interesting question. So like you referenced, I am here in the near western suburbs, which is where this meetup is, originally started. What I find is that inventory is super, super low in some of the areas that I work in. And not only is it low, but the prices are a lot higher, which is great for the sellers and is not as great for people trying to get into the game. So that's been a challenge for sure. If you want to talk like neighborhood specific, I used to do a ton of business just in Berwyn and Forest Park. And right now, it's really challenging to find something that will cash flow there. You guys probably hear my kids are busting out on me. So they think this is great. I'm home. The other thing that we're seeing is that kind of opportunities are shifting around. Like some neighborhoods that have been hot a few years ago are getting kind of oversaturated. And we're also trying to find those new pockets of opportunity. I really enjoyed, speaking of the podcast, the last episode where you talked about Little Village, which is one of the areas we've been kind of keeping an eye on. There's been a lot of opportunity there. So anyway, to backtrack to your question on what do I tell a new buyer, we have to tell them that it's very challenging if you're an FHA buyer right now. It's really, really challenging. Mostly everything you want is multiple offers. For pure investors, there are still some really good opportunities. You just have to kind of be patient and not, don't rush into it. Don't think you're going to read that podcast or listen to that podcast or read that blog on the burst strategy and go start like the next week. It might take you a month or two to find, or even 3 or 4 to find the right deal that'll make sense.
How has your advice on this phone call changed from February to now? Like what else do you asterisk your conversations with when you're talking to a new investor looking for you to possibly find them a property?
I think a lot of it goes back to trying to set expectations for what the market's giving. So that's a really interesting question you had. In February, I was still pretty like gung-ho on FHA being a really great strategy. It's been really challenging to close. I see a few of you on this call that I have closed deals with FHA, but they're not easy to do. So I think, if people are using the FHA loan, tempering their expectations that you're probably not going to hit a grand slam with that particular loan product. That's been one thing that we've really tried to talk about a lot. And then inventory being low. So you have to look at a lot of different areas. If you're an investor, you can't just look in one, little town or one little neighborhood in Chicago. You have to think a little bit bigger. So, maybe you're like, oh, I want to buy in Belmont Cragen. Well, maybe you will, maybe you won't. Maybe like your money might not line up with a deal there in the next couple of months. So that's one of the things we talk about a lot.
Cool. I think I was thinking about this today. I've been a real estate agent since 2003, and there's a couple other real estate agents on here. It used to be you spent so much effort finding the property for the client, and then once you got under contract, the attorneys kind of took over, and it kind of was fairly on cruise control. And I think in the last 5 years, it's shifted to a lot of clients find a lot more properties, or the search is easier, maybe because there's less inventory. But then once you get under contract, that's where the real work starts for real estate agents, or that's where deals die more so than ever, than offers maybe getting rejected these days. So I don't know if you guys would share that, but I was just kind of making that observation on what it's like to be a real estate agent from the last 15
that
years.
And every time you're a buyer's agent, if there's a really good deal that makes sense, everybody else knows it makes sense too. So there's typically 8, 10, 12 offers on it if it's listed on the market. So kind of coaching people through that too. It's hard, right? Like highest and best situations, you don't always know the right answer. Like how much should you offer? I mean, somebody else might offer just way above list and you just never get it. So then to your point, there's a lot of things that go under contract and die in that especially that first 5 business day period, the attorney review inspection period. So yeah, kind of, navigating that as well is crucial.
Well, let's go. I want to pull that out. The highest and best. I listened to a very boring Illinois Association of Realtors legal show or podcast the other day, and they talked about that. What's your recommendation as far as, what do you advise your clients to do when they're in a highest and best situation?
Put yourself in the seller's shoes. I think it's easy for us to think from the buyer's position, but if you're the seller, I mean, what motivates you? And sometimes we can get a feel for that, as a buyer's agent. Sometimes you can, get your hands around that. Sometimes you can't. When I'm listing properties, I can tell you that many sellers just want the most possible, but not all. There's plenty of sellers that are also looking at this and saying, I really want the best outcome, and I don't want to take the highest offer that's super risky, which again kind of goes back to FHA. So if you have an FHA offer, you probably will have to pay more than everybody else if you want to get something, just because your loan product is not as strong. So it's really thinking like a seller, I guess.
Jay from iPhone asked the question, what about FHA loans is making it harder to close on? So you just kind of said it again. Kind of lay out specifically what's the pain in the butt about FHA loans.
So from the seller's point of view, they have like an extra, like I call like a mini inspection component. When the appraiser comes through, they say, oh, this window needs to be repainted. I mean, they find the dumbest stuff a lot of times. I'm sure those of you who are like, Tom, I'm thinking when you flip properties, you probably sell to FHA buyers sometimes because they tend to pay the most, but it's the most annoying loan product. Sometimes if the loan officer is not any good, you can get, kind of stuck in the process, especially with that appraisal or, inspection. And I think there's also probably not always correct, but there's also this assumption that all FHA buyers are newbies, that they don't know what they're doing. So obviously there's many people on this, in this group tonight that are very smart that would use FHA mostly for the leverage, but it's really designed for that first time buyer. think so. That's the other thing too. You're dealing with somebody, when you're the seller or listing agent, you're dealing with somebody that may or may not be a pretty new buyer. So there's nerves and things like that.
Yeah, the timing I think takes a little longer. So Tom, when you're flipping properties, and I'll ask you a question about what excites you about flipping in a second here, but while we're rolling on the FHA conversation, when you're flipping properties, is there anything specific that you are making sure you're doing to head off in the FHA inspection that John's talking about?
Yeah, I mean, so it's a loaded question, right? When we're flipping, like we do like these very extensive 6-figure type rehabs. So me personally, I'm not overly concerned with the FHA end buyer, right? And especially also because it's different when they're buying a home than buying an investment. The odds of them getting cold feet and backing out is, at least I'm assuming in my head, lower, right? But like, let's say you have, 2 unit, 3 units, something like that. If I owned one of those and it was dated from the 60s, in the back of my head, I know it's not going to pass an FHA inspection. I'm not going to mess around with it. So like, it's a little different in my scenario. I'm as a buyer of, a flipped property that's going to be done to the nines, I'm not overly concerned about it. Head to head, I'll go with the safer option, right? Like I'll take something 5-10K less on a 600K deal that I know is going to close. But like, if you guys are looking to buy like a 4-unit or something along those lines that's dated, that's where the buyer there's going to be issues. Like something's going to come up that's not going to align with the FHA inspection, and whether, you got to go up to have him covered or whatever. That's the whole reasoning behind. So I guess a little bit of a different ball field, long-winded answer.
So one thing that probably would affect you as a flipper, or John, maybe you can speak to this, is if you get an FHA appraisal done and it comes in undervalue. I don't know how many people are getting undervalue appraisals these days. I know it happened to me for a property in Woodlawn last week. But if you get an appraisal that comes in undervalue, that FHA appraisal stays with the property 6 months. So if you're asking $300,000 for a property and you get a 260 appraisal, you can kill that deal. But now any other FHA buyer that comes into play, you'll have to honor that. So you either eventually have to accept 260 or find a cash or conventional type borrower. I don't know if you guys knew that. I know I got burned on that one the other day.
Yeah. I just lived through that. I had 2 listings this year that have come in low on appraisals, and one was FHA. And we literally had that conversation with the attorney, and the sellers had to eat the difference. I think it was about 10 or 12 grand. It was, not a good conversation to have because we'd had highest and best round. We got, we took the highest offer. They were really excited. They were going to, do okay on this after all. And then boom, the appraiser comes in bad. And it's so subjective and it's frustrating. And, one could also say that if they had the right loan officer, maybe it wouldn't have happened. That's the kind of the gray area of real estate, but that definitely happens. And it's frustrating if you're the seller, that's for sure.
Pritek has a question. I don't necessarily know the answer, so maybe you guys do, or if there's someone in the crowd that knows this answer. What are other options besides FHA for low down payment? Or what do you recommend instead of to be 20% conventional? Is tough to save up for. So, is there any other alternatives other than FHA, so you don't have the stigma of offering with a FHA loan? You guys familiar with any of those products?
Yes, so our team does a lot of that. So the one that used to be out there that you still hear talked about a lot in bigger pockets is the Home Possible 5% down conventional. It sort of still exists, but it's pretty much impossible to use. So the hard part is people say, "Oh, I just talked to some random fill in the blank loan officer. They said I could still use it," and you're like, "Yeah, it could happen, but it's not likely to happen." The one that we have started to send out is there's a credit union that we got. Actually, Bree found the information, my managing broker, and they're doing a 10% down. It's not really conventional. They call it conventional, but I think it's like an in-house type thing. It's very similar, low interest rate, really good terms, and it's 10% down as long as you're in the Chicago area. So that's been an option. We're doing one of those right now.
I almost said we'll leave it in the show notes, but I don't know if we'll have show notes for this. But maybe
we can leave it in the show notes. I'm sure we can figure it out in the YouTube video when we post it.
If you put it in the comments, we can add the comments to the show as well too. So so don't say anything bad in the comments, anybody.
Yeah, right.
So skipping along here, we can kind of bounce back on that. But Tom, I've never, I've known you for about 2 years now, and I've never seen you so excited about flipping. And it hasn't started happening since the market kind of crashed. I know you're nervous at first, but what makes you excited, or what makes what you're doing right now more successful for you than maybe January? Like, so kind of give us what you're looking at from your side of things, and tell us maybe first what neighborhoods you're flipping in, and give us a little backdrop on what you're working on.
Sure. So, you know, for me, flipping is a tool, right? Like, you know, our real estate investing is all about increasing the net worth, and the flips kind of fuel that machine. So if it was easy for me right now to be scooping up rentals left and right, that's what I'd be doing. But as we've talked about earlier, that's very, very hard to do. So we started, you know, focusing more on flipping, and there's less competition there. There's a lot that's been going very well. You know, we've executed well, but also we've caught a great tailwind here. Because think about like the timeline of a flip, something that we analyzed in March that we put under contract, you know, that's just hitting the market today. And the market has done nothing but go shoot up. So like a good deal that was going to land us whatever, like 50K profit, like is now 100, right? Because just from dumb luck with riding the market. So, you know, it was good. It goes from good to great. I think specifically for my situation, like Mark mentioned some of the neighborhoods, we like to do everything on the Northwest side. I live in the Northwest side, so that the Norwood Park, Jeff Park area, Portage Park. We've started venturing more towards like Hermosa. We have one right now there. We have one in Logan Square. And then also like the 60618. So North Center, Irving Park. We haven't done anything east of the river. You know, we'd love to. It's super competitive. So we found a nice little niche here. One thing that's helped us over the last 6 months is think about like, if for those of you know the area North Center, you know, a tear down is like 300K, right? And what was happening is these builders would do it. They tear it down. They put their 500, their 600K into it, and they pop up a 1.2 ugly McMansion. You know, that's 3,500 square feet, and that was their business model. A lot of those guys they're not doing anything right now. You know, they have longer hold periods. They have been scared with this market. They've gotten out of the game. And so what we've done a lot is we've taken, let's say, that existing 300K house that's 1,600 square feet. It's small. It's not the ideal house that someone's going to want to spend a lot of money on. But we've been doing like very, very extensive rehabs to get it to the nines. So it's the same finishes that, you know, ground up construction, but you're getting 1,600 square feet or whatever the existing footprint is compared to the 3,200 square foot McMansion. But we're giving it to you at 6.25 or 6 or whatever the ARV is for the neighborhood compared to like that 1.2. And like, there's just insane amount of demand there, and people are starting to figure that out. But we went through like competing with builders, they got out, we had a nice little window, and now more people are starting to do our model as well. But it's been very good. It's also, when you start doing those bigger numbers, it's nice because, you know, Mark, you know, like these Southside properties, you know, there's only so much you can make on a property worth 150K. Like there's 150K of equity. There's only so much you can make minus your expenses. On these bigger ones, you do the same amount of work. You take on more risk for sure, but there's a much bigger upside on there. So it's been a really good market for that. It's something if you're like new, I would definitely not recommend it. But like for me, like that's when we've been, you know, stacking our chips over the last couple, call it 3-4 months.
What have you done differently though? So you might have underwrote a deal in January a different way than you do today. What's different, or what would you advise other people to be more cautious of these days? Yeah,
there's been a lot that's been different. So still gotta be, I'm sitting here preaching how awesome it is. You gotta be careful. Like, I'm definitely cautious. I think one good question, this is from like BP or somewhere, but like someone asked the question, like when you're analyzing a deal, is this deal going to be in the top 75% of deals I've done? And I think if you ask yourself that question, it becomes very binary, yes or no to proceed. So like, I always use that as like my guiding force of like, is it a good deal or is it a great deal? Like, is it in that top 75%? And if so, that means I should, you know, shift my momentum to make sure it happens, go 100% all in. And if it's not, forget about it and move on. It just makes like the decision-making process a lot easier. So like, we've been more cautious with it. I've been using more private money. Lenders that I've used for a long time have tightened up. You know, I use Lending Home, which is one of the most like, they're great. They're one of the best hard money lenders. They have been, you know, they won't do a rehab over 100K. So if your rehab's 170K, like that's 70K out of pocket, plus they're only giving you 85% of the purchase, whatever. So like on these bigger deals, like, you know, yeah, they're giving you a loan, but it's like, you're still coming out 150K. Like it's still a big number. So like, we've had to figure out other ways around that. We've extended timelines. There's been delays in lumber. There's been delays in appliances. And then there's been closings, even your best people, even if it's, hey, I'm doing conventional, they're going to ask for 60 days in the contract now instead of 30. And it's going to take 45 to 60. So, little things like that. But like, for the most part, we're being aggressive when it calls to be aggressive. There's a difference between just being aggressive and being aggressive in the right moment.
Cool. Estrada, he has a question. What's your typical rehab timeline? Kind of from contract from the day you're closing to getting on the market. What are you trying to hit, or how are you trying to find deals? What type of timeline?
Yeah, from contract close to get on the market. So here, I'll walk you through like a pretty good one. And I see another question here about permits. Permits for us is a day. We pay Windy City their expediter, and I can give you their info. They'll get you the permit in the day. Now, if you're talking drawings, it's a week or whatever. But like, we don't mess around. Like, I'm not spending my time going to City Hall. I'll pay the $400 and get my permit emailed to me that same day. So let's say we closed on a deal. I'll give you a timeline. We closed on one yesterday. So yesterday we closed on a deal. That permit was up in the window within about 20 minutes of me closing, and they're demoing and tearing the thing apart. It's a 12-week rehab, so let's call it 3 months, right around that timeline. It's going to get staged. We're going to need a week to get photos, get it staged, get it up and running, and then we would hope it would close in those first 2 weeks. In reality, we're going to underwrite for, call that a month, and then we're going to underwrite another 2 months to actually close. Like, once we're under contract, we're going to underwrite 60 days to get to that finish line. So a typical deal like that is going to be underwritten at 6 months. And I say that's probably we have a little bit of buffer in there. So I think that's pretty standard, and we're doing pretty big rehabs. These are like, over the 100K type of rehabs. We're not adding square footage, but we're usually taking it down to everything and just going from scratch.
So you don't have
one thing too. I'm sorry, like we're in the Western Burbs meetup here. Ironically, Chicago is actually very easy with permits, which you'd think is counterintuitive, but the actual city of Chicago is actually very, very easy. I have properties in the suburbs, and it's not as it's more cumbersome than dealing with the city.
Now, in case anybody, I think I know somebody on this, someone that will disagree with you, but he might have bought properties in housing court and a whole bunch of other different baggage he's bought them with. So when you're not buying properties with baggage, or they're coming, or you're getting stop work orders and stuff like that, that's a whole nother ballgame compared to what Tom is saying here.
I see another one here about the 75% rule. So like, all right, so I don't want to throw out rules of thumbs because everyone's different. The way I calculate something is, how much do I want to make on this thing first and foremost, right? Like, you got to think about it more as a business. That 75% rule is a great rule, like to be like, if you're eyeballing something and thinking, okay, cool. But then you got to sit down, like, what am I actually going to make, right? What is the whole reason we do this? And then what are the risk factors? What are the worst things that can happen? And can I live with those, right? It doesn't matter if it hits the 75% rule if it's too risky. Like, it's not, I don't care if it hits that rule. And there's ones that are in our neighborhood where we've done them, and, we're fine with, being skinny because we've done 4 of the same bungalows. So, but if you're getting started, I would almost say like 70% rule. And the way I do it is I actually take the purchase and the rehab and divide all of it by 0.7. Like, that's what I would do if I was starting. So like, I would take, if it's 100K and it's 50K rehab, take 150K, divide that by 0.7, and is that your ARV? Is that where you're going to hit? Like, that's, as a starting point, that's what I would do if I was, this was going to be my first flip.
That's good. So you don't have to give us your secret sauce, but are you buying these properties on MLS? Are you doing, are you finding them off market? Kind of tell us how you're finding these deals that are hitting these numbers. It's
a little bit of everything. So it's been I wish my marketing was more systematized. I know, John, you do direct mailing. There's probably others in the call who do this better than me. I have VAs who make phone calls for me. So I have 2 VAs in the Philippines, and we download lists from ListSource. We look to target certain demographics meaning like, equity in the house, not like personal demographics. And then, we go and we have them make phone calls, and it's very inefficient. Like, I wish I was better at this process. It's something I'm working on, but the cost is so low that, like, it doesn't matter if they're inefficient. Like, you're paying them, $7 an hour. And like, if you're going to make 50K off of one deal they bring you. They can work a lot of hours to get you that one good deal. So like I'm working on that. I wouldn't say like that's something you should model after me, like, cause I'm trial and erroring that thing right now. But yeah, that's been a big one for us. We're in with a lot of wholesalers. Once you get in with the wholesaler and you close in a week or whatever, and you're cash, like you're seeing that before everyone else in this call gets blasted out an email. So it's that chicken and the egg of getting in the door. So that's been big for us. We're still buying off MLS too. Everyone craps on it, but like there's not a lot of people that will take a property that's worth 300K and think like, oh yeah, I'm just going to go put 150K into that thing and make it perfect and take on all that risk. Like it's too small for the big boys, and it's too complex for someone who's done like one or two deals. So it's still competitive. Like we're still having bidding wars and it's still whatever, but you know, it's less competitive than on the scale of craziness right now. The market is at a 11 out of 10, and that's like an 8.
Let me ask a question to, I guess maybe Tom or John. I know, Tom, you talked about this on a podcast before, and John, you might be experiencing it. Escalation clauses. Are you guys utilizing those when you're buying your own properties? Are you using that with clients or anything? And for those who don't know what an escalation clause is, it's putting an offer in and basically almost having an auto bid up like you would like in an auction until you get the highest point. Are you guys utilizing any of that? That seems to be popular lately.
I've used them. Oh, sorry. Yeah, I was gonna say I've used them. I think we're probably like 1 for 4, 1 for 5. The one thing that I've found that can be frustrating with those is you'll do like your escalation clause, and then the listing agent will call and be like, "This is great. We'll just take your highest offer at the very top." And you're like, "Wait, did we beat the other offers?" And so there's sometimes a little bit of that goes on. So it's one tool in your toolbox. It's not my favorite tool, but it's there. You know, we do use it from time to time.
Yeah, we've gotten one deal using it. What I would say is if you're going to use it, your agent needs to ask the listing agent, what's your opinion? Will you guys accept an escalation clause? Because they might tell you, go pound sand. They might say, no, give us your final and best. And you've just eliminated yourself and not giving yourself a chance. So just ask the question first. And they might say, whatever's the highest price is what we're going to take. And then okay, well, I have nothing to lose by doing the escalation clause. So I think just knowing what the other side of the party, where their mindset is, what's important to them, and then it might, in certain situations, it would make sense.
I'll tell you this. I think a low risk thing you could do in an offer, and maybe you guys will agree or disagree, but is earnest money. Your earnest money, very protected by multiple different ways you could get it back. And I will tell you this. I don't know how many deals, maybe it's got to be over a couple thousand deals I've done in my time. I think I've only seen earnest money forfeited less than a handful of times. And it was a couple of those handful of times where like the buyer disappeared or one guy went to jail or something like that. But so like earnest money just doesn't get forfeited that often. So if you're putting $15,000 down on a property, some of you are saying, well, I'm not putting much down, but if you're putting 15 down, put 10,000 up for earnest money. Cause you know why? The next two people will probably only be putting 1,500 or 2,000. And if you're going to have that money in your bank waiting for closing, you might as well put it up there to get the deal. So I don't know.
There's a flipper I work with, Mark, that he actually would offer, because he does cash offers and he does the full thing in earnest money.
I've done that before. Yes, I have done that before.
It just makes a statement, right? Like it just shows like, hey, I'm buying this property, right? Like I'm going to close.
And as is as well too. So I think the investors here, we use as is a lot, and that doesn't mean you can't get a home inspection. That doesn't mean that you can't send your foundation guy out there. It just means that you can't come back and nickel and dime the seller for GFCIs or door hinges or something like that. So keep that in mind as a tool.
That's the theory, Mark. Although I'm not going to lie, I've negotiated even with an as is before.
Yeah, no, again, when you go out there and it's like, hey, listen, you can always spit it to the listing agent and say, listen, I did as is, there's a lot of stuff going on here. And a lot of times I know if I was the listing agent, I'd be like, well, tell me about it. What are you thinking? And I'll bring it to my client. So again, that's a good way to get your foot in the door. You can't use the tactic to try to sidebar it every time, but it's always I'll tell you this as a seller standpoint, the as-is part makes me feel a little better because I know I'm not going to get a list of 74 things that I'm going to have to even, just spending my time looking through the 74 things to know what it is, that's not worth it, my time. So I'd rather see the as-is. Tom, you were saying there, So we got a wholesaler here in the crowd. So if anyone's going to get on somebody's list, you could drop that over here in the chat. But John, you bought a couple properties recently. I think for your own portfolio. Correct me if I'm wrong. How have you underwritten those deals differently than you might have a year ago?
Yeah, I'm under contract right now on a 22 unit. It's distressed, and a year ago I might have said, "Oh, we can just kick everybody out in 60 days. Worst case scenario, it might be an eviction for 3 or 4 months." Now I'm looking at, it might be the first 9 months where it doesn't really make money. So this is like a value add deal. So it's all about the upside, but we just have to kind of underwrite the risk that we may have a lot of non-performing tenants for the first 6 to 9 months, and there's not a lot we can do about it, with the courts being closed. So I think giving yourself more of a buffer when you're taking on a big project, knowing that you may have some people not paying rent, which isn't fun to talk about or to underwrite, but it is what it is. It's reality.
Are you doing anything during the due diligence or while you're under contract to request some sort of proof that the tenants in place are paying? Almost like a verification?
If this was a stabilized property, 100%. The reason I'm getting the price on this particular property I'm getting is because the owner doesn't even have tax returns from the last couple of years. It's an absolute joke. The rent roll was a sheet of notebook paper that they scanned over. So on this particular deal, no. But if this was more stable and I was buying it, truly on a cap rate and more at market value, yeah, I'd probably want to see bank statements and things, if it was a little bit of a skinnier deal, and really see where the money's going in and out and be able to audit it.
Okay. Yeah, no, I've actually seen estoppel letters starting to be used a lot more frequently in the last couple of deals I've seen people buy. I've actually tried advising people, and I've seen it come in a couple of times to almost, hey, show me proof of rent payments for the last couple of months, just to see that they are paying. You're almost like underwriting the tenant at that point.
Are you seeing those get done as part of the transaction, or is there a lot of pushback? Or it seems like for me in the 2 to 4 unit world, a lot of times there's almost a lack of knowledge about what that even is amongst even attorneys or agents, things like that. They don't even know what it is.
I think the attorneys are having to come up to speed to it because ultimately the questions are coming up in due diligence now. I mean, it's just it used to be, I said this to people, it used to be a benefit to buy a property with tenants in it. Now it's almost a fear.
Yeah. Yeah.
So Gary Chan asks, do you use the 2836 housing expense DTI ratio in considering income qualification for renters?
And Mark, you could probably answer that better than anybody. That's right down the middle for you.
Yeah. So 28, we're looking to have at least typically 3 times when it comes to just their base rent. We don't break it down as so much as a ratio like that. But the one thing that we've always tried to be big on is having some sort of paper trail for their past rents, even before COVID. We call landlords, and I almost think it's a waste of time, but I feel people need to know that we do it. But, I could put Tom down as my landlord and say, hey, I'll buy you dinner next week. When this guy calls, tell him this, and this. So I want to see paper trail similar to what we're talking about in buying properties of that rental payments for the last 3 months. And it's easier too now where things are electronic, where you could snapshot a lot of stuff.
Yeah, I just want to add to that too. Like if you have a small portfolio, like you can't do it at scale, but if you have just, a couple houses or whatever, and they give you this was my last landlord and this was the address, look up the address, look up who actually owns the building.
Yeah, we verify tax records for that. So if they have
screening, 7 or 8 people, you can really find out all the information and be, your own little private detective. Like there's ways to figure out if they're BS.
Yeah. So when you look up when Robert Smith applies at your place, and then Betty Smith is the owner of the property he's paying rent to, then there's a good chance you're related. Now, Smith is a very bad example for me to use, but if Betty Shallcross owns a property, then there's some sort of kind of relation there that is not really a good reference. So John, going along those lines, as far as the underwriting, are you accounting for any sort of longer time to rent stuff up, or how are you doing that? Are you still, for us, our rental market, I'll say this, for the handful of tenants we had to get out or working on getting out from all these COVID problems, we've been able to backfill it with what's so far been reliable tenants. Is there any sort of accounting in that in your underwriting?
So I'm curious here what you guys are seeing, Mark. So our team is doing leasing right now for 3 clients in 3 different parts of Chicago. We've got one in Berwyn, which is kind of my normal stomping grounds, one in South Shore, and one in Naperville. So it's kind of interesting to see all the different markets. Berwyn, we had, I think, 30 or 40 hits in the first day we put the thing online. It was insane. I really don't see us having an issue getting renters in this area. South Shore, I'd never done any leasing in. I was able to lease a 2-bedroom apartment for a client in about 4 days. So that was pretty intense. Again, kind of swarmed with applicants. I think the biggest problem is getting the bad tenants out right now, not getting the good tenants in. I'm still sensing that there's a lot of great tenants out there. And I guess you look for the obvious red flags. Like I've had a lot of people say, oh, I'm on unemployment. Probably going to take a hard pass on those. But there's also a lot of good ones out there that have good, stable jobs. And I guess the nice thing is if you're selecting the tenant, you get to kind of pick the ones that you know have the jobs that are still going to stay open, if the pandemic continues. So I'm not really underwriting long vacancies for the upcoming apartments based on what I'm seeing. No.
That's good. That's good. Yeah, no, I would agree. I think the only probably properties we're having trouble filling quickly, which this is a pre-pandemic, is just when you fall into the C or even some borderline D property areas where you just got a 2-bedroom, 1-bath for $1,000, or a 3-bedroom, 1-bath that's got nothing special about it, maybe no garage, no laundry unit. I think those, no matter what the climate is struggle. And I'll tell you this, you just got to price it right. I always tell to people, the best applicants gravitate to the best conditioned properties that are priced the best, the fastest. It leaves all the rest of the tenants to have no choice but to go to everything else. And you don't want to be in the everything else category. So Jay iPhone asks, could you explain the risks of taking on a tenant in a building you are buying, including the previously? So I'll just follow up. You guys could tag on if you want, but if you close on a property tomorrow and that tenant upstairs is not paying, you can't go in and just evict them like you normally would, or cash for keys has become more expensive. We could talk more about cash for keys, but cash for keys is the concept of, instead of taking someone through the eviction process, knocking on the door saying, listen, I'll give you $2,000 to get out by next week. And what was always good for us, cash for keys is, when I say it's gotten more expensive, is we used to be able to say, we'll give you $2,000 to be out by Tuesday, but if you don't, we're just going to file for eviction and we'll screw up your credit. And we give them a whole horror story on what that looks like for them if we have to go that route. It almost makes the $2,000 and getting the hell out of there attractive. Now it's like, hey, I'll give you $2,000 and you be out by Tuesday. And if you don't accept it, I'll come back and offer you another $500 next week. So we've lost the kind of the back side. The other side, my kids do the would you rather. Would you rather take $2,000 to be out Tuesday, or would you rather me drag you through eviction court and really mess up your record? So that is, you don't have that. So when you're buying that property, you don't have that luxury anymore of, one, the tenant, there's a really good chance the tenant might not be paying, or even if they are a good paying tenant, there's a percentage of tenants out there that are just taking advantage of this opportunity. Hey, you can't evict me, so I guess I will just try to pay. I won't pay, and then I'll move out right before maybe you can evict me 3-4 months from now. So that's kind of, I don't know if you guys want to add on to that, but you just lose that that certainty that tenant's paying, and if they're not paying, being able to get them out. Because even if you buy a property that's occupied in DuPage County, that's not bad. I'll tell you this: we've only had to do a handful of evictions in DuPage County over the years, but that's night and day compared to Cook County. But now you don't even have that leverage if you're buying something in like DuPage County to get them out right away.
Yeah, I mean, I don't do evictions regularly. I think sometimes people on Bigger Pockets talk about, oh my gosh, you're going to buy properties and have to do evictions. I mean, it's really, if you buy in pretty good areas, it seems like it's a rare thing, hopefully. But what I'm finding is it is hard to kind of train or keep people in line if you don't have that stick as the last resort. So hopefully the government will stop messing around with this soon and start allowing the courts to open back up. Mark, have you heard anything about that? Like the eviction attorney I use was able to file a case at least last week in Cook County. it's not like the person's getting evicted, but at least they were able to do a case and everything like that and have a date.
Well, was it filed pre-COVID or did he file actual?
Oh, yeah, this is like not, this is post start of the pandemic, and it's not related to COVID. So I know that there's that CDC eviction ban if it's if your income is whatever is down because of COVID, but this particular one is not because of that. Apparently, it's not my eviction, so I don't know all the details on it.
Well, I don't know if that's necessarily. So I know you could. I see different attorneys right now trying to take different angles, maybe going in of saying utilizing 10-day notices to evict on. That's another one. But right now, the state ban goes through. Is it October 19th, 12th or 19th? And then the Chicago one goes 60 days after that. So that puts you into December. Now, the CDC one runs through the end of the year, but there's some loopholes. You have to actually qualify. And I'll post, I was going to say I post the show notes, but I wrote this all out yesterday. But there's 5 things that you have to meet the criteria. But the final criteria of those 5 things ends up being, hey, if I as a judge evict you, will you have to possibly go live with family members or be homeless and spread the corona, potential for corona? So anyone can pretty much say, hey, I'll have to go live with my family and there's 7 people living there already, and then they'll get out. So all the criteria leading up to that one makes it possible, and that's the one that runs through the end of the year. So I've been just we've prepared to just not be able to have that as an option. Now, the scary thing is, so let's talk about what 2020 looks like. The scary thing this year is, when does that end? When does the governor, the city of Chicago mayor, they stop extending out these dates that are going to, there's a percentage of landlords that are getting killed by not having that stick, or, we have a few tenants that have just gone underground. Like, the only way we get to communicate with them is if we go pound on the door at 6 a.m. and hope they still open the door. So we have a couple of those that, man, we just have nothing to do with them. And if this gets extended past December, I mean, that's, I don't know. It's just, we can't control all those situations, and that is starting to take a toll. I think they'll start taking a toll on a lot of landlords, where it's something everyone's got to be conscious of getting in that situation. But at the same time, it opens up the opportunity where, now, we had on this week's show, actually, that comes out, we talked to the REO specialist, the Smith from Remax. They did more foreclosures than anybody in the last 10 years. But, in our show, we talked about kind of what the process looks like to evict somebody in Illinois. And based on that, the timeline where any of these type of people that stop paying, foreclose on somebody, but by the time anybody stops paying or stops paying and going to foreclosure and judicial sale and go through that process, any benefit that us as investors on this call see of like, oh, I can't wait till all these properties start going to foreclosure, that's going to be 2022 at that point. Now, the real opportunity that I think ends up being is back to what I was originally talking about, is the landlords that are just going to get worn down by the process of tenants just not paying and them not be able to do anything about it. So I think that's where some of the true opportunity for anyone on this call will come in the next 6 months. Is just people getting worn out, or the wife yelling at the husband because I told you should have never got into real estate, and they sell the property for a deep discount, and Tom comes along and picks it up. So that's where I think the true opportunity is in 2020. And I think the true weakness is going to be trying to figure out, navigate some of these tenant issues. John, are you on the brokerage side of things? What are you thinking is going to happen with inventory? I'm totally asking you to get out the crystal ball here, but what does inventory look like? I mean, if I was a seller right now, I mean, listen, but let me word it this way. As an investor right now, I'm thinking, man, now's the time to sell. I could probably get rid of stuff quick, at least under contract quick. Like, what you would think that more people have that mentality, but what does the future for inventory look like? Call it maybe the rest of this year, or call it into spring 2021. Like, do you think it'll come back in that sense, or do you think it's going to stay tight like this?
Yeah, it's been a really strange year for inventory, right? It's been very low the whole year. And I think this is going to sound counterintuitive, but I think the best thing that could happen is if interest rates would go up a little bit. It just seems like that's not helping. I don't know. A lot of people may just think, let me just refinance forever. Yeah, I don't know. I don't know what the exact driver is. It's going to allow inventory to go back to a more normal level. I mean, when I was a newer broker 5, 6 years ago, you could just start a tour and go take people through, 8 properties. Today, it's like no matter what, if you're in single families, condos, 2 to 4 units, multifamily, there's like, let's look at these 2 things that meet your criteria, and you got to pounce on them immediately because it's like, oh, it's been on the market for 3 hours. Like we just listed a 2 flat this yesterday and got a full price offer. Boom, done. It's just insane. And the seller was almost blown away. That's a problem. Like there's just not enough inventory. So yeah, I don't know what's going to really, allow inventory to go the right direction. I mean, in this area we can't really build, right? I guess if you go far enough west or far enough, northwest, you could build more, but there's not, unless Tom, you can start buying some lots and build more inventory. There's really not a lot of that available though.
So let me ask this though: will the unknown of how much inventory will actually come to the market in the next 12 months, will that create a pent up demand, or will the people that were going to originally buy figure out other things? Like maybe, I know a big thing in the Great Recession was like, looks like I can't sell my house, so I might as well put 50 grand into building that sunroom off the back. Like, how do you think that'll change as far as pent up demand or versus just people choosing making other options?
I think people might take other options for sure. We see that in the 2 to 4 unit world where if you can't land that FHA loan for 6 months or a year, you're like, I'm out. So you see that some. I know with single families, we have some residential kind of retail clients right now that they're changing their criteria and moving further and further from where they want to be because there's just not enough of what they want in the area. So that's a good possibility that people will just kind of change their sights a little bit over time. But like you were saying, I think a lot of sellers are kind of eyeing this and they're salivating a little bit, say, wow, look at the prices. They keep shooting up. Like, why would I hold on to this thing? Especially depending on where you're at in the triennial reassessment cycle. If you're in Cook County, you might look at the tax bill. Maybe next year is your year, and you're going to get whacked. You think, hey, this is a great time for me to sell to the next guy. So something a lot of buyers should be aware of for sure. Where they're buying in that cycle and where their taxes should go. And I think a lot of sellers, should be aware of that too, because it's easier to sell when last year's tax bill is still low, comparatively speaking. So yeah, there's a lot of different angles there to look at.
Tom, where do you see inventory going, and how it'll affect buyer habits, I guess?
And that's a loaded question, right? Like, demand's gonna stay high, right? Long term, you're thinking the 5 years, are people going to leave the city? Probably, right? There's still going to be plenty of opportunity though. Like, I think it's much more, those macroeconomic data points are very important, but having a plan and being able to execute that plan is much more important. I feel like you can drop me in the middle of Iowa and I'll be able to find a way to make money if I can execute a plan, right? Like so I don't worry too much about it. It's ignorant to avoid those or ignore those factors, but I think, finding your team, being able to, this is what we do, this is how we do it, and executing, like, that's much more important than speculating, where populations are moving. You need to consider it, but like, it should not be your main driver.
John, have you considered going to the downtown loop? I know we were talking about that with another broker here before. Have you considered maybe just going down the loop and start making lowball offers and picking up good deals that way on maybe some of this condo inventory? That's seems to be, that's the one place there is inventory.
Oh, John might be frozen, or he's staring at us real hard. Hey, so Mark, there's a bunch of questions in here. Do you want me to fire some of these out?
Yeah, go on, fire a couple of those out. Yeah, I know you've been keeping an eye on it.
So going back to tenants. So Mark, to you, question for Mark, and then after that, a question for John. Your feelings on Section 8. There's a stigma when talking about CHA tenants. Mark, I know you have a ton of experience there. And then John, when he's done with that, are you able to Airbnb in Cicero?
So Section 8, I think some of the people that have Section 8, that question having Section 8 right now are pretty happy. When we started really getting to Section 8 heavy back in 2008, unemployment was pretty high. So the comfort level of Section 8 was there for me. I really liked it, which probably is the same feeling I have now for the Section 8 properties I have, or when I talk to investors questioning me about Section 8. So Section 8 is great, but there's a lot to learn about Section 8. So if you guys ever want to check it out on my website, I have a Section 8 Resource Center page. And it's, believe it or not, is the most heaviest visited webpage on my entire website is that, and all the associated links. So, there's a whole bunch of stuff on Section 8 there. There's a lot to learn. I could stand here I could stay here for a whole hour talking about it, but I think it's part of a strategy when you're doing things. There's certain areas that Section 8 numbers will not work for you. It's hard to rent it's hard to get the DHA, two-page housing authority, to pay the right rent for a house in most of the housing stock in Hinsdale. So just understanding the areas and where you get most, but also at the same time, there's south suburbs that you actually get more rent for a property from Section 8 tenants than you do market, almost like 20%. It's crazy in a couple towns on there. But you always have to underwrite at the market level and take the Section 8 money as gravy. So, Section 8 has a stigma to it just from, I don't know, it always will, but you just have to understand it and know how to make money in it. If you ever want to talk about it more in depth, I'm always around to give you if anything, maybe we do a show someday on Section 8 specifically in Chicago, Tom, and talk about kind of the must-knows.
My one Section 8 tenant, the one on Crandon, we haven't had 2 years now, haven't had a single maintenance issue. You just got to show up for the inspection each year. It's insane.
Yeah, no, I like it. There's different levels of Section 8, and I won't dive more into it than that, but there's just different, you hear people say that it's awesome that Section 8 pays 100% of it. That's not the good Section 8 for the most part for us. And we like the tenants there, we call them working Section 8, where they might have a $405 portion. So dig into that more in another time, but I definitely am pro Section 8. And I think, so I've invested heavy in the South Side and South suburbs in the past. And I like to have almost a 50-50 mix of 50% market, 50% Section 8, because it really balances out it stabilizes and reduces some of your risk on the market tenant side of things.
So Tom, you asked if you can do Airbnb in Cicero. That's a really funny question. I have not seen a lot of it in Cicero in particular. It's more of a C-class market. There's going to be a lot more of it, maybe like Oak Park, Forest Park, something like that. I still think Airbnb is used a lot, but I think it was probably even more prevalent in the city than the suburbs, but I've seen some of it. Is the short answer. I'm sure you could do it in Cicero, though, if you wanted to.
Cool.
So we must have other questions here. Mark, you got to post your website.
Yeah, I will do that. I'll do that.
Right.
Does anyone else have any other questions?
Any funny joke there, but I won't.
John, can I just ask out loud? You talked about how some of the retail buyers are going further out because they're not finding what they want locally. What kind of things are they looking for that they can't find locally?
Well, when I say locally too, so I live right here, near Riverside, Oak Park. There's a lot of this vintage housing stock. So, I mean, 2,500 to 3,500 square feet with an attached 2 or 3 car garage. That just eliminated the attached two or three car garage just eliminated like 90% of the houses in the area. So if that's what you want, then you end up pushing further west. So we see a lot of that. So if you get that attached garage and open concept, man, that's where it's at, I tell you.
Yeah. Okay.
But kind of like Tom was saying too, is interesting to talk about this, but I think a lot of times the houses you do see like that tend to be 4,500 square feet, 5,000 square feet. They go for a lot more money. It doesn't really matter which, nice suburb you pick, whether it's Elmhurst or whatever, LaGrange, or it's like you tear down the $200,000 to $300,000 house and you build the McMonster mansion. And there's a lack of, I don't know if you want to use the word affordable, nice houses like that 2,500 square foot with a 2-car garage in this area, but it just doesn't make economic sense to build them. Like if you're going to tear down a house, you got to build a really big house to make it worth tearing the other one down and paying the holding costs. So that was a long-winded answer, but
you do. And I think a lot of people are scared to take on those bigger projects too now. And banks, I think, will start tightening up a little more of that. Even though banks have more cash than ever right now, I think they're still going to be very conservative with it, especially when it comes to speculative type stuff.
Yeah, financing was interesting. Tom, how was financing for you during the beginning of the pandemic? You mentioned you're using some hard money and stuff. Yeah, I was trying to cash out a private money or hard money loan, and it was crazy. None of the banks were lending. My main bank like went dark on me for like 6 weeks. It was insane. I was
Yeah,
curious if it was the same.
it was terrible. Like it was like personally, I'd never been a more financeable person like ever, and it's like, you know, you're not able to get anything. Like we were using a lot of just private money. I was using my own cash. Like we were scrapping around to get things done. Um, getting the hardest part I felt was like no one was giving straight answers. Right, like during that time I was refinancing a 6 unit I had, and it was like, I will pre-COVID we can do this. I was like, well, it's not pre-COVID, it's COVID. What can you do? Like, what is the answer? Do I continue down this path with you or not? Because, and then everyone wants to see, your tax. It's a pain in the ass, right? It's not just like I have a W-2 that I can go hand someone. It's
Yeah, personal financial statement, schedule of real estate owns, your firstborn child. What else do they want?
yeah,
The
it's
the
ridiculous.
irony of all that is, so we have a few commercial buildings. Is to get $1 million or a dollar loan is easier than it's easier than anything else than doing that. So
So
you always hear people say, go to the commercial type stuff. It's easier, and it truly is in that sense. So you have something to look forward to as everyone grows their portfolio to get more into the commercial loans.
funny story on that. So like I'm actually looking at a 4 unit right now, and I was like, ooh, it's 4 units. I can do personal financing. This is great. And I don't know if I can right now. The first lender I went to, they're like, well, we're going to count all your expenses, but we're not going to give you credit for any of your rental income.
Yeah.
And I was like, oh, so I have to make like $5 million a year to cover my expenses. Like that's like, it's insane. Like that's because not only do you have to cover them, you have to cover them at a ratio of like 40% or 30% or whatever. So for every $1,000 of, expense, you need 3,000 of income. And it's like, when you take away all the rental income, like this is a joke. Like there's no way like anyone's going to qualify for this. And so like I'm actually using, it sucks not being able to lock in, but if I go down this route and actually get the deal, I'm going to use one of the commercial lenders I use, right? And it's going to be a 7-year ARM, and it's going to be 25 AM, not 30, but it's going to be the same rate. And it's like, it's mind boggling to me that I have to go this route, I guess is what I'm saying. Like you're getting punished for having properties.
We were able to get at least our 7-year deals extended out to 10-year. So that actually made me feel a little more better about that. Because, during the Great Recession, I saw a lot of people that refi time hit right as 2009, 10 hit, and the banks were doing anything. So, but yeah, so we're going to wrap up here. I want to get everyone out of here on time. A couple minutes late. I don't want to overextend my invite here by John. If anyone has any final questions here, I got one here. If anyone has it, pop it in there. We'll go over it. If it's 8 o'clock and it's supposed to end, you're more than welcome to stick around. We'll stick around for a few minutes. But and then John, anything else you have to say at this point?
Yeah, no, that's it. Just make sure everybody, just let me know if you're interested. And a lot of people did in an in-person meetup. No pressure. We'll do it on Zoom as well. So if you don't feel comfortable next month, all good. You'll still be able to join on Zoom. I got to figure out how to do the breakout sessions. It'd be really cool if we could mix the two, right? Breakout sessions with people there live. It'd be kind of fun. I have to think about that. No, that's the main thing. But yeah, if we want to do a kind of a last final round of questions here, that'd be great.
So ADUs, basement, attic units, any updates from the city? When I'm looking at a 2-unit house with a basement, can I reasonably expect to rent out after moving out? I've heard it depends on the alderman in your area, but I'm not sure how to think about these types of units. So not to take away from this show, but we did do a great podcast with an awesome architect that talked about ADUs and what's on the horizon with that. Maybe Tom, you can pop that link in there for this. But I know there's some stuff on the horizon out there, and the person, I'm not, I can't speak to it 100%. I can tell you my own trials, tribulation, but you probably want to speak to the gentleman that will refer you here in the notes here.
Yeah, I'm dropping that in right now. The gist of it right now is if you can leave the building as is, you can rent it. No one's going to mess with you unless the tenants call 311 on you or something along those lines. If you go to pull permit or do some sort of rehab on it, that's when they're going to say, hey, this is non-conforming. So talk to an architect. I don't want to give bad advice here, but that's kind of like the high level gist of it.
Yeah, you got, the amount of, I'm not props to us or anything. I'm not trying to solicit us, but man, the amount of value that I got out of that one we did, Tom, with Prashant was huge. So we should drop the link in there. It's a great episode. And then Prashant is really awesome. You guys can find him on Bigger Pockets as well too, and harass him that way if you got questions. He'll always take time for you.
Trying to get him to be a guest too, just FYI. I have him on. He's going to be on at some point. Just trying to get a date firmed up.
Yeah, no, he's a wealth of knowledge. How difficult of a process to convert a 2-unit to a 3-unit basement of a property? I have had the potential to be turned into a unit, but want to see if it's worth the trouble. So I'll speak to this real fast. In my experience, the couple that I've converted or made that 3rd unit or that 5th unit legal has been a pain in the butt. It costs a bunch of money. I think in attorney fees, it cost me a bunch of money. One time, hell, I even had to buy the lot next door to go from 4 to 5 units just to have the parking ratios, because we had a coach house in the back and I didn't have a parking. So it's been a challenge for me personally. I'm a big fan of duplexing down or up versus having that illegal unit. But sometimes the numbers make more sense to convert to unit. So the question is, some of the questions you have to ask is really how the unit's laid out, your ceiling height, your amount of light, the amount of actual how the heating's set up. So those are some things that again, that architect that we'll drop in the notes here answers a lot of that in the show.
Hey, Mark, put a suburban flair on that. If you're in the near western suburbs or like some of the southern suburbs, it's pretty much impossible in my experience. Like the towns are very anti new units.
Yes. Places like out in Elgin, they'll actually pay you they'll give you like 25,000 unit to deconvert some of those old houses back to a single family. So.
I'm actually looking it up. My attorney, how to do it in Chicago, like tactically, like step by step. I have that somewhere. I'll find it and send it.
It's a lot of work though. And it's probably not worth the opportunity cost, I think is what you're saying, right, Mark? Like in a lot of cases, you could just spend that cash buying another building.
Well, what we found for us, and I might botch this math, so don't hold me. So I'm going to say it's just off the top of my head, is you take a basement unit, a basement that has a finishable component to it, and you drop another couple of bedrooms and a bath, and you get another $400 in rent for it, versus making it a legal unit, spending a whole bunch of money on not only the legal component, but now you got to put a kitchen in it. You got to do the egress. You got to pay another management fee on it. You're going to pay your taxes go up on it. Now you have a 3rd unit where you might only get 900, 1,000 for it. So you got to really do the math of what, if you're going to utilize the space, maybe it's better set for, maybe put a laundry room that adds value to the other 2 units, and you duplex down for part of it, and you get another 30% rent for that first floor you might have. So you got to kind of run the numbers a couple different ways to see really what your best way is to maximize for it.
I just sent like what he had sent me in an email, because we were actually looking at some of these single families that we are flipping. We've actually looked at like certain areas. We're like, man, this would be a great just 2-unit. It's already set up that way. It would be pretty easy to convert. And then also what makes a big deal, this is very Chicago specific. So if you're in the Western burbs, like it might not be applicable. But the zoning permits, if there's already X amount of 2 flats on the block, the lot has to be a certain size. It just makes, you can bypass a lot of the hairy, scary parts of this. So if you have a city block that's like half 2 units, half single family, your chances of, or your ease of getting approved are higher, if that makes sense.
Cool. All right, John, thank you for having us on here. Thank you for letting me lead the conversation. Everyone else, Thank you for putting up with me leading the conversation. Tom, as always, thank you.
Yeah, Mark, you're a first guest to be back twice in 1 year. So you just set a record, man. Yeah.
I guess third time too. So this
third time's the charm, baby. We have 2 more coming up. So
John, you can use that projector that he made you buy, or?
Yeah, you know, it's funny. So the good news is I'm using it with my kids. They're doing family movie night on that projector. So at least I'm getting some use out of that thing. But man, that sound system I bought. Yeah. Wow. Great investments right there. So anyway, I'm glad everybody was able to be here. Like I said, so next month, we're going to be exploring potentially in person. So just keep your eyes open for, I'll make sure I blast that out as early as possible. And either way, we'll be here on Zoom too. So really excited about next month. The guest is not 100% firmed up, but most likely will be a tax attorney. So that should be fun. Talk a little bit about how to save on taxes. That's about it. Thanks everybody for coming tonight. This was great.
Thanks, guys. Great job.
Thanks all. Appreciate it.
Thank you so much.
Thank you.
Thank you, guys.
Thank you, guys. Have a good night.
Night.
See you, everybody. Thank you.
Thank
Night.
you, everyone.